Okay, so welcome to the week 5, or is it week 6, of the Maxine Pierce Executive Speaker Series. We are just really want to thank Maxine Pierce for generous donation and other donors like this to Western make fun educational programs like this happen. So we want to make sure we give Maxine Pierce just a huge thank you from all of us. A little bit before I turn it over to Tyler to introduce our speakers tonight, I want to talk about next week. Next week we have an executive from Medics. Medics is an HR recruiting company. They are across the country, and they're going to be talking on how technology is affecting HR practices, especially for you who are getting jobs for next year, you seniors. This is going to be a great talk. So we're excited about next week, so be looking for more information. And so I want to turn it over to Tyler Hannenberg, my student intern who is the coordinator for the speaker series. Thank you, Tyler.
Thanks everyone for being here, and hopefully Zoom gets up and running for anyone else. But today we have Tom and Glen, and Tom graduated from CSU Fort Collins with a bachelor's in accounting, and is also the Pacific Coast School of Banking, University of Washington. From 1983 until now, Tom has worked in banks starting as a management trainee, owning hotels, bars, and restaurants, to currently being a Chief Administrations Officer of Alpine Bank. So thank you for coming. And Glen graduated from Western Colorado University and with a degree in business and also industrial education tech, and which we don't have anymore, found out sadly. He started as a management trainee with Alpine Bank and has been working roles such as the teller, lender, branch president, bank director, and then current position of president and vice chairman at Alpine Bank. So thanks again everyone for coming, and thank you too for being here to teach us some great topics on bank.
Great. Thanks, Tyler.
Thank you.
Appreciate that. Tom and I promised to stay 6 feet apart from everybody, so we're going to take the masks off so you can hear us a little better. So I appreciate the introduction, Tyler. Like you said, Tom and I have both been in banking since essentially we got out of college. And Alpine, a little bit about Alpine. Alpine was founded in 1973 in Carbondale, which for a lot of you know is not very far from here. Started in Western Colorado. We've got 40 banks across the state. We're currently the second largest bank based in Colorado. So, and really kind of cut our teeth in Western Colorado. So I'm proud to be a part of that. And I'm going to share a little bit with you today about the current state of community banking. And but I'd like to keep this interactive, though. If any of you folks that are here have questions, jump in, ask, and at the end we'll have questions as well. But we're happy to hit those as we go through. Okay? I think we're ready. Technical difficulties.
Yes, I could start talking.
We can always wing it if we have to too. And I'll tell you, that is a talent and an art that's never been more important and will continue to be important. So learn to wing it.
You're absolutely right.
Okay.
There we go. I'm going to start out real quickly with just a brief kind of overlay of where the economy is at right now. I think we all are keenly aware of what's happened over the last 6 months. Some of the materials I have, I accumulated earlier in the summer, so things have changed even since then. But this slide came from JP Morgan Chase and is really pretty current as of September 30th, so just a couple of weeks ago. We have seen some recovery. Initially in March, the economy just completely shut down. Unemployment skyrocketed, I think 16% might have been high. Since then, we've recovered about half of those total jobs. We're at 7.9% unemployment, which, if you keep in mind that consider full employment between 3 and 4, so 7.9 is bad, but it's not terrible. Retail sales kind of had a quick recovery, and why is that? Because people weren't spending on traveling or entertainment, things that you simply couldn't do, dining out. Instead, they were buying stuff, but they weren't buying stuff from the mom and pop shop. It was online delivery. the theme kind of today that you're going to hear over and over is the next phase. You know what? There's still a tremendous amount of uncertainty out there as to what's going to happen going forward. If we continue to have a lot of outbreaks, if we have to shut back down again, or maybe things constantly improve and we're on our path. Probably the single most impactful part of COVID, certainly on the banking side, is what the Federal Reserve has done. Immediately in March, they cut interest rates down to essentially zero. Fed funds rate, which is kind of the basis. Right now, their recommendation is between 0 and 0.25%. They have pumped $9 trillion into the economy in the last 6 months. It comes in 3 different forms. One was stimulus money. So almost every American got a check for $1,200. A lot of people spent those, some saved them, some paid down debt.
And that was about a third, looking at
Pretty much evenly. A lot of this came through a lending program. One was called the Payroll Protection Plan, or PPP for short. Alpine Bank participated in the PPP. We did about $300 million in loans. To keep that in perspective, our goal for 2020, a year ago in December, we said, okay, how much do we want to grow our loans in 2020? 200 million. So we did 300 million in about 6 weeks, which was our entire annual goal plus 50%. It was an all hands on deck, everybody working from home 12 hours a day, just trying to get through that process. And then finally, QE. Anybody tell me what QE is? Yes, sir.
Quantitative easing.
Bingo. Quantitative easing. It's another tool that the Federal Reserve uses in their toolbox. Essentially, they go out and buy bonds on the open market. And what that does is means the seller of the bond now has cash. And they can do other things with that cash, hopefully put it back into the economy. Since then, what we've seen, it's kind of strange. The stock market took a huge drop. And now, a month ago, it was hitting all-time highs. It's tapered off a little bit now. Of course, we're getting close to an election. That's influencing the stock market as well. But the primary drivers of the stock market, though, it's not the traditional companies. It's all been driven by anybody that benefited from people staying at home. So Amazon, of course, Google, technology companies in general, and then retailers that could deliver. Walmart, I think, has been a beneficiary, but not your typical oil companies, not so much. So that's just a quick overlay of kind of where we're at.
So maybe a quick just snapshot of what does that mean for us in our micro part of Alpine Bank. You know, in March, some of you visited us in March. Shortly after that, we closed all of our branches, shut everything down, appointment only, had to be online, phones, whatever. If you'd have fast forwarded to where we are today and said, here's where you're going to be, we just said, that is awesome. Because after that shutdown, we've been beneficiaries to some degree of a lot of that. Our bank, which was roughly a $4 billion bank when this stuff started, it's now $5 billion. We've grown 25% back in 2020, which was, we expected to be there in 2022. So that was our trajectory. Our loans are way up, obviously deposits are way up. Earnings have been getting compressed. We'll talk about that as we get a little further into it. But all in all, we've been the beneficiaries of some of this. And the market's done well, and we've tended to outperform the market. I think we'll talk about this too, to a great degree because of where we're located. You guys were in Gunnison this summer, saw some of that.
But the growth is not just related to Alpine. Pretty much banks across the country have all grown their deposits because that $9 trillion had to go somewhere.
So what are the significant risks the bank should be concerned about now? So just kind of a look at banking in general. The economic side, low rates. With all that money that went out, the Fed's not planning on raising rates anytime soon. And that's the enemy of a small bank, is the low rates. We live and die on the spread between what we take deposits in at and what we bank loans at. Our deposits are already priced basically at nothing, so they can't go any lower. But loan rates continue to track down, and as loans pay off, the new ones come on the books, they're at a lower rate. So we're going to continue to see that. Unemployment, who knows where that kind of goes? I think there's when it dropped, unemployment went high to like 16%, now it's back to roughly 8%. Part of that is the benefits, the checks people were getting for unemployment, folks didn't go back to work in some cases because they were getting paid more than being a waitress or working at the hotel, or so they stayed away from work. So is that going to come back some more, or are we going to see something else with that? Bankruptcies. The jury's out a little bit on what happens with some of those large commercial buildings, retailers, those places that are they going to bounce back? Are we going to get another blast of COVID that's going to slow things down? Demographic, the decay of cities. There's a couple things going on there. By having 40 banks, I've traveled around to all of our locations over the summer just to visit, check in. We've got one downtown Denver, Union Station. It's always on the 16th Street Mall. It looked like a ghost town compared to all the rest of our markets. No conventions, so there's nobody in the hotels. No baseball games, no hockey games, none of that, so there was nobody out with that. But the real hit was about all of those big office buildings that have 3,000 or 4,000 people employed in them were empty. So what's going to happen there? And then you throw in some of the rioting and the things that we saw over the summer. What does that mean for places like that? And again, I think we've seen the benefits of that in our markets. Real estate's through the roof in most of those markets. Home sales are as high as they've ever been. Pickens County, which is where Aspen is, third quarter had $1.1 billion in real estate sales. 1 quarter. So it's just ridiculous what's happened with that. Acceleration away from traditional delivery channels. People, they're not coming to the bank as much. Our transaction counts up, our in lobby stuff's down. So are you prepared for that? Are you ready for those kind of things? Political. Talking about capitalism, we got a lot of election pressure coming. So I think the question is, what does that look like after that? That's another unknown thrown into it. Talk about being nimble and being able to adapt. So what's that going to do? Were the tax rates going to change? What's going to happen with that? Demise of moderates. You guys see this from a political standpoint. Regardless of what side you're on, it's disturbing to me to see that they're so polar opposite. And it doesn't seem like there's much middle, which is where most of us, I think, belong and live. Breakdown of institutions, and that kind of more on the political side right there. Technology, you know, the cyber attack guys and the people that are breaking in and doing fraud, they didn't go away when COVID broke out. They thought this is an opportunity for us. So
they already worked at home.
in their mom's basement in Russia somewhere. So they're busy. They're still working. So we continue to see those kind of things. We had what was it called? The stuffing deal where they
Credential stuffing,
where they just throw all this data at your system to try to crack into your code. So they get your Amazon password, then they start shooting all that at all your other accounts, trying to get in your bank account, trying to get into everything else. What does it cost to build enhanced systems and keep up with that? It's an expensive process to do that when you're a smaller bank like we are. So the second biggest in Colorado, but not Wells Fargo. So
we're in the process of doing budgets now for next year. I spent the whole morning with my IT director going through his budget. It's about $13 million. And all I could hear was, we have to upkeep this system, we have to replace this particular system's at end of life. We're adding to security. Every employee we hire requires more data storage, so we have to add the storage, so it's just a constant battle.
And if you think about the technology costs, when I started banking in 1985, we put in an ATM, and it was really a cool new thing. But we still had to maintain the teller line, so we added the ATM to that. Then when I was running our operations, we added online banking. We still had to have the ATM and the teller line. Then we added mobile banking. We still had to have the online banking, the ATM, and the lobby. So those costs just continue to add as we have multiple delivery channels. Now, some of them are much more economical to deliver on, but you still have to upkeep those and keep up with the competition. My guess is, if you look at your banking app, you don't compare it to the other bank's app. You compare it to Amazon. You compare it to the other experiences you get, and that's what you expect from your bank or anybody else.
Okay, so that's kind of economy and overall risk. Let's kind of start drilling down a little bit into some specifics. So the next few slides, we're going to deal specifically with declining multiples. That's talking about our stock or bank stocks in general. Downward earnings pressure, we've already touched a little bit on that. We'll look some more at it. Consolidation, there's a lot of industry consolidation going on now. Loan modifications, slow loan growth, faster deposit growth, we've already mentioned, and regulatory uncertainty. So declining multiples. probably, if you've taken a finance class, you always are talking about the PE ratio, right? The price to earnings ratio. I did some research on banks between 500 million and $1 billion. That's in assets. That's typically your average community bank. We're obviously a little bit bigger than that. Back in 2017, the average publicly traded community bank was trading about 18 times their earnings. In 2020, that's down to 9. If you look at book value, so tangible book value at a multiple, that's another way to look at your price. Price to book in 2017 was 143, so 143% of your book value. Today it's 94. So you think about that, if a stock's not even trading at its book value, theoretically, you liquidate all your assets, you pay off all your liabilities, and this company's worth more by liquidating than it is what the market's trading at. So why is that? Because investors are concerned, and for good reason. There's so much uncertainty out there. Glenn talked about the difference between what we take deposits in and what we make loans at. In business, we call that our net interest margin, or NIM. NIMs have gone from, in our case, from probably 4.7 down to probably closer to 4. So on a percentage basis, down 20%. Our customers, a community bank really is a reflection of their community. And you think about the communities we serve, there's lots of restaurants, there's lots of hotels, people that are struggling right now, and that shows up in our loan portfolio. So we've been fortunate so far. We had a good summer. We're not seeing a lot of that, but across the country, investors are concerned about credit losses at banks. And then, of course, election coming up. We got a tax break in 2017. If we get a new president, new House, new Senate, probably some of the tax rates will change rather significantly. So you look at those three things, that can have a big effect on a bank's earnings. But good news, trying to be an optimist, things have definitely improved since March. We had a good summer. It's all about what happens next.
What hasn't improved since March was our bank stock took about a 35% hit, which is pretty much typical of the industry. So the values dropped by that. And what the investors and the investment community now looking at that, it really doesn't matter if you're making money, if your margins stayed up, if you're growing, if you're not growing, if you've had loan losses or not had loan losses. We're going to wait and see how this plays out in early 2021. If we get another outbreak of this stuff, or we see more bankruptcies, or we see more credit losses, it's kind of a wait and see. Doesn't matter how you're doing right now, we're just waiting.
So from an investment standpoint, somewhere out there, it's going to turn and go from a PE of 9 to a PE of 18 again. The question is when.
So you talk about the negatives earning pressures here to stay at least through 2022, and I hit on that a little bit. But with all that money that's come into the system, the Fed has no intention of raising rates anytime soon. So that's one thing you can be pretty sure of. They aren't going anywhere. Yes, Liz?
What would happen if we went to negative interest rates?
We'd be Japan.
But would it affect a smaller bank?
Absolutely it would, because it would create more compression.
It's almost like your balance sheet completely reverses. So we would, right now we charge on loans, we charge interest on loans, and we pay you interest on deposits. You think about negative interest, suddenly we're probably having to charge our depositors just to deposit. And on the loan side, you're paying your loan customers to take money out. So it's a very bizarre phenomenon. Not good for banks.
Well, I've also heard that probably the United States wouldn't do that.
That's
even though Europe has.
Yeah, Japan.
I mean, I think what we're looking at, and that's one of the things we can probably be relatively sure of, is that that's going to be pretty much like it is for a while. So we need to be prepared for that, for the low net interest income, surge in prepayments. So there is a refinance push that goes on there with rates being down. The other thing, like Tom and I talked about, is if you've got a loan you took out 3 years ago at 6%, you may not refinance. You may come into your bank or your local friendly community bank and go, hey, Glen, I can get that at 4% down the street. So we reprice that, which drives that margin down even further. So we recognize that compression is going to continue. So what do we do? Non-interest expense control. So when we're spending money, what do you do to really watch your overhead?
So what's the largest non-interest expense in a bank?
Wages?
People.
Well, now it is. It used to be interest.
Yeah,
Paid out.
exactly. So Alpine Bank has gone 47 years without laying people off. So that's just not who we are. That's really not an option. So we're probably looking at some other things. We'll get to that in a minute.
Well, and a little bit of that, just thinking about what do we do to maintain where we are. One of the things we've done with being a community bank, we believe in philanthropic support of most of our communities. We're generally, every year, Colorado gets ranked on most philanthropic organizations in the state, all types of organizations. We're typically second or third of any organization in the state, whether it's Excel Energy or whoever. So, that's one of the things we want to make sure we maintain those relations, that support, because a lot of times when things aren't good, that's when they need it the most. So really, how do you maintain that? How do you maintain not laying people off, which we've never done? How do you continue to take care of your customers when they need help and they're going through a tough time? So not cutting back on those things, but really watching what you do to continue to get rid of expenses you can live without. And then what do you do to generate other fee income? So mortgage loans have been really busy lately, so we got a lot of mortgage fee income, but that's not going to last forever if rates just hit a flat spot. And real estate slows down at some point. In some of our markets, it is slowing down because there's nothing left to sell. A lot of our resort markets have half the inventory they had a year ago, and they didn't consider that a large inventory. So that's going to continue to slow down. But the unknown is the loan loss expenses. So two ways you have loan loss expenses. One is sticking it in a reserve and holding on to it to be ready, a loan loss reserve. And most banks, the industry in general, funded a bunch of that in the first half of the year. They said, we don't know what's coming. We're going to shoot a bunch of money into that just to protect us. So the industry in general is in pretty good shape there. The other expense is what happens when you got a $3 million loan and the borrower can't pay on their commercial building and you sell it for $1 million. You eat the $2 million. So, that's what we don't know is coming there.
I just got through, bunch of these are, wow, I don't know how many, banking class. It's all we've been talking about is capital adequacy.
I want to loop back real quick to fee income. So big difference between a community bank and a money center bank, big bank like JP Morgan. JP Morgan at times will make as much money off of their investment banking and brokerage as they do off their commercial bank. Community banks don't have that. We don't go out and do mergers and acquisitions and get huge fees. We live off of our net interest margin. So for us, Glen mentioned our mortgage operation is one fee income. Debit cards, every time you swipe your card, the bank gets a little bit, but when you have hundreds of thousands of cards and millions of swipes, that adds up. And then the third area, we have a wealth management department. So if you have an IRA or maybe you have a trust, you come to Alpine Bank and we'll help manage your money. That's purely fee income. So different depending on the size of the bank.
The one thing that the industry is we're in much better condition than the last recession. So that means capital, the banks are much better capitalized. That's their war chest. Their reserves are much better. Loan loss reserves are stocked up much better. Liquidity, and what kills a bank, banks fail because they run out of cash to pay their depositors. Banks are typically extremely liquid now, especially with that $9 trillion that went into the system. And then the other thing that I'll touch a little bit on here, we don't have a slide for, Tom mentioned the regulatory piece. We are in an extremely regulated industry, but as all this happened with the COVID outbreak, the regulators kind of came together and said, we're going to give banks some flexibility to make sure they can work with their customers in the way we did some loan modifications and some changes that normally we'd have been criticized for, or the accounting requirements would have made us do some weird troubled debt renegotiated. We didn't have to do that because they came together and did that. So, we're in better shape there now. A change again in the political outlook could change the regulatory outlook, which could make that more difficult. But right now, everybody's kind of rowing together on that.
Consolidation. In 2000, there were almost 10,000 banks in the United States. Now there's 5,000. So half of them have gone away. And all that happens when net interest margin gets pressed, technology expenses go up. Some smaller banks just throw up their hands and say, I can't do it anymore. So they try to sell their bank. Last year, or so far, there's been 48 transactions as far as sales of banks around the country. Last year, it hasn't been below 200. So very slow right now. My guess is once the virus kind of certainty goes away, you'll see a lot of banks say, I'm done. I'm not gonna do anything. This, again, accelerates in a low interest rate because even if you can put up with everything, you're just not gonna make much money. And so then you have to say, okay, is there something else I can do that's more worthwhile? And regulatory, just keeping up with all the regulatory requirements.
And when you look at the bank shrink, a lot of that was smaller community banks that are serving a little community in rural somewhere in the United States. And there's a couple of things going on there besides what we talked about there. One is that the cost to keep up with technology. When you're a small bank, you can't scale that. The other thing is there's been a bit of the folks that started those banks in a lot of cases where grandpa started the bank in the little town in eastern Colorado because they needed a bank. Well, so he made a good living at it. Maybe one of the kids made a good living at it, but now they're on the third or fourth generation. They're not interested in the bank. They're not interested in being in a little town in eastern Colorado. So there's no talent coming into those. There's those people are retiring or leaving. There's nobody to run those. What's even happened now in this market is there's nobody to buy them because they're not worth anything, because nobody wants a small little bank like that.
On that, so with those like small towns, is that something that you guys, you have 40 locations, is that something that you guys would acquire at some point, or is that something you guys just open new locations in different areas?
Our model is different than a lot of banks, and we've acquired one bank since 1973. That was the bank Tom worked at in Telluride, Uray, and Ridgeway, Montrose. We acquired that bank. It's the only one. We're not really built for that. Our design is we hire young folks, train them, and then try to find opportunities to start new banks. But part of that is just the way the model works now is you can do everything on your phone. So we're really trying to put banks in key locations that can serve a large area, and then you fill in with the other part of it. I think even though you want to do most everything on your phone, you still want to know you can go to your bank if you need to. And that's my own personal philosophy is you don't want to go to the bank, but you want to know you can.
You're seeing so much competition from like Goldman Sachs, everybody else, like my personal loans.
Yep.
Yeah, I mean, I couldn't believe it. 15 a week.
The banks anymore, when you build a physical bank, it almost has become a billboard.
It's a big sign with some people wandering around it.
And people drive by it and they think, okay, I know that's there. But really what happens is it's all on your phone.
And where we meet our customers generally, build our relationships, isn't in the bank. It's at the fundraiser that the Western State Wrestling team's doing over here. It's at and we participate in those, and we really encourage you. We don't just encourage, it's expected of our bankers that you're very involved in your community. And those relationships are what translates into the business. So if it's not in the building, you're not building those. You're building those in the community. Now, the next thing on this loan modifications and what's coming with that, kind of a big unknown. So one of the things that the regulators allowed us to do was they said, hey, banks, you can go out and give your customers a 6-month deferral on their payments, and we're not going to kick you in the head for that. We're not going to say it is troubled debt renegotiated. We're going to let you do that. So our philosophy was we're going to give everybody 90 days right out of the gate. You just ask. You don't have to show us anything. You don't have to do anything. You're your customer. You've been current on your loans. Just ask. We'll give you 90 days. So we had about 27%, just under a third of our customers said, sign me up for that. Give me that 90 days because I don't know what's happening. And then we went back to them and said, if you want another 90 days, we're happy to sit down with you, but we want to understand what your plan is to work through what's happening. How does your business look after 60 days into this? What's your plan? What do you think you're going to do? You're going to shut something down? You're going to fire people? You're going to hire people? What are you going to do? We had probably more like 7 or 8% of our customers got that second round. Because a lot of them in our resort community said, you know what? My business is doing fine. I went to, we have a customer in Uray that runs a restaurant. I was there in August. Went into the restaurant, sat down with the owner, at dinner, and we started talking. I said, so how's your summer? He goes, well, he said, in March, I figured if we did everything right, we had some space we were using so we could add more tables while we distanced everything else, so we could kind of keep it up. I thought if we did everything right and everything worked out perfectly, we'd be down 25% from last year, which was our best year. He said, we're up 50% from last year. Every weekend's the 4th of July. This place is packed. He didn't come back for a second round. Did he? We talked about so that how the loan modifications, forbearances, and those troubled debt renegotiated play out. What's that look like when you get to the next year? we will have some customers come back that maybe they run a little commercial strip center that, you know, they've lost some tenants. They're gonna not be able to make their payments. We'll work with them, but the accountants will say that's gotta be trouble debt renegotiate, so now it kind of gets on our bad guy list for the regulators. Many banks, like I said, we boosted our loan loss reserve, allows for loan and lease losses in the first quarter, so banks are positioned well there. The industry in general doesn't believe that this is gonna hit the residential side like it did 10 years ago. It's gonna be some of those office buildings, maybe the retail outlet spots. The commercial real estate side.
So commercial real estate being office buildings where people aren't working anymore. Retail, where, you know, if there's a mall, you don't really have malls in Gunnison, not as many on the western slope, but you go to the Front Range and especially back east, people are trying to figure out what's another purpose that we can do with this real estate, because retail isn't it. Loan growth is another problem banks are facing because of the uncertainty. A lot of people don't want to borrow money. Alpine Bank's been fortunate over the past 6 months just because of people wanting to move to the mountains and buy a house. We've been really busy trying to keep up with real estate. But again, economic uncertainty, quicker prepayments means our loan portfolio actually been shrinking. Unattractive rates, attractive for a borrower, but as a bank, if we're going to put our whole portfolio in at 3% and then suddenly interest rates start back up, that's a problem. That's what you call the S&L crisis. That's exactly what happened. Early on, people had trouble even getting to a closing. The appraisers couldn't go into people's homes. The title companies were closed, so you couldn't all gather for a closing. So everybody had to pivot, kind of create new ways to close a real estate transaction.
And now they're so damn busy, they can't get to your appraisal or get to your closing.
So as I mentioned, some of all these things are kind of offset by residential property and specifically resort residential property, which is done very well.
You know, what we're seeing in our markets is we've got people from Denver buying a place in Glenwood or Grand Junction, or they're getting out of the city. But Denver's seeing a lot of people, they're coming from New York because they view Denver as a outside, outdoor environment kind of place compared to where they're from, LA or New York or Chicago, some of the major cities. They're moving to Denver, and Denver's real estate's real similar to ours. It's gonna get hard as far as the purchase prices go. They're through the roof. You know, in a lot of our resort markets, the realtors are telling customers that are out of the area, if you want to buy a house, make an offer today at least listing price before you even look at it. Because if you come to look at it, it'll be gone by the time you get here. Make an offer, get it under contract, then come and look at it.
Okay, the flip side is we talked about $9 trillion sloshing around in the economy out there. Well, it ends up in the banks. And so suddenly our deposits have grown tremendously. But how do we invest them? And how certain are we that those deposits are going to be around for some amount of time? A lot of people have gotten out of the stock market. They were concerned about what was happening. It's like, well, I'm going to just stick my money in the bank. I don't care if I'm not making any interest. At least I know it's there and it's safe. Initially, there was a desire for liquidity on the bank's part because the last crisis, there was no liquidity. This time, there's an overabundance of liquidity. So just completely different. Trying to buy bonds or invest the money's really tough. I mentioned that the Fed's doing quantitative easing. They're out there buying all the bonds, trying to find a bond that you can buy at least 1% is really a challenge. Some banks had what we call wholesale funding. So instead of having what we call core deposits, so if all of you banked at Alpine Bank, we consider your checking account and your savings account as a core deposit. Year round, you're going to use us. The other way to get deposits is you go out and you can buy them kind of in the secondary market. So these are investors from around the country that are just looking to place cash, and if you pay the right rate, you can get some money. So some banks are saying, well, I'm going to get rid of all that wholesale funding because now I have plenty of deposits from my core customers. And then also offset by preparing for longer term funding, just trying to find somewhere to park the money.
So Tom will have to endure this because he hears me talk about this a lot. But I really, in my job, try to focus in on three things people perspective and simplify. So I'll explain what I think that means for our bank and I think to some degree the industry in general. And I think it applies to much broader than that. The first one is we're still just people dealing with people. You can throw all the technology at something. You can throw all the issues that pop up. And I think the last 6 months is a good example. People still have a need to be around people. And I think we've seen it. We've seen some of what's happened when people were isolated, what happened. You watch the people that health deteriorated because they were isolated. So we're still just people dealing with people. Let's not forget that. Let's not get too caught up in technology. Let's not get too caught up in all those other things. Let's keep that in the right perspective. Keep that balanced. The second one is perspective. You know, I mean, we talk about, we bounce back to people, and I'm talking about 3 groups. So one is our employees, making sure that we continue to work together well, focus on that. We have what we really focus, one of our concepts is collaboration. We expect our people to work together closely, and our model is really designed to be a collaborative one. It sometimes makes it hard to manage, but I think makes the end result better. So our employees, our customers, making sure we deal with them. And in this case, we may have some people who are having some trouble making their loan payments. They may be worried about losing their business. We want to make sure we treat them with respect, dignity, and work with them the best we can. The last downturn 10 years ago, some of our best customers today were some of those that we had to really work with then. But we treat them with respect and dignity and work with them, and they said, well, I want to bank with you still, even though maybe you did foreclose on my business. But they understood why, and we worked with them, so we were in it together. And then our communities. What do we do to make sure we support our communities? Tom said this earlier. As a community bank, we rise and fall with the tide of our community. And if our communities do well, we do well. If our communities are struggling, we're going to struggle too. That's just how it works. We're a reflection of that.
So real quick, people interjection. Every year we have a leadership summit for all of our officers. We go to Vail, we hire a speaker. A couple of years ago, we had a lady named Molly Fletcher who billed herself as the female Jerry Maguire. I don't know if you've seen the movie Jerry Maguire. He's a sports agent. So she's a sports agent. And she said something that was a huge takeaway. She said, if I don't want a deal to happen, I do it through email. If I want a deal to happen, I do it face to face. And I think that's true. Sure, that's millions and millions of dollars that she's dealing with. But for us, it's the same way. If you want to be successful, it's going to be face to face.
And, you know, we've had a setback the last 6 months in how that works, but I think as humans, we need that interaction. The next one is perspective. And I think this is the other thing we do as humans. We tend to focus in on the rock that's in front of us. And when you do that, you always hit that rock. So I spent a lot of my younger years riding a dirt bike on single track trails. And you see a rock, you look at the rock, you hit the damn rock. If you see the rock, acknowledge it, and look past the rock, you go by that. And so I think one of the things we really try to focus on is broadening our perspective. You know, is this COVID thing been a tough time? Yep. Is banking in general a business where we're seeing consolidation? It's tough with the technology, not even talking about the last 6 months. It's not an easy business, but then which one is? You know, there's change, you need to be nimble, you need to be able to adapt. So making sure that we understand that our industry, just like any others, requires us to be able to adapt. You know, and really looking at the broader picture of what can we do to really balance out those things and look at where we are. We live in great communities. We live where people want to live. One of Bob's first tenets when we started the bank was, our founder Bob Young in 1973 was, I wouldn't put a bank any place I wouldn't live. So we tend to be in places people want to live. Because they want to live there, that's why they've been here this summer. That's why we've seen things do well. So yeah, there's some rough things we're going through. The industry in general's got some challenges, not even counting COVID, but we're in good places. We get to deal with good people, resilient communities that have been through a lot of ups and downs before. I have a friend whose 93-year-old mother got COVID in the memory care unit where she lived. She survived, and Mike said she wasn't worried about it. She said, I've seen smallpox. I saw bomb Pearl Harbor. She had some perspective where she understood this isn't the end of the world. It's what we're dealing with now. And let's do the best we can at dealing with it. So that's the perspective part. And the second one is simplify. This one, life's complicated enough as it is. And I think sometimes we start worrying about, stressing about, trying to figure out how we fix something we have absolutely no control over. What do they say? 90% of the stuff you worry about doesn't happen. The other 10% you can't do a damn thing about anyway. So really focusing your attention on what you can control. doing those little things right day in and day out. And I look at now, we had to pivot a week after those of you that visited us left, and we were working from home within 24 hours. It wasn't because we had made an intentional effort to do that. We had done the little things right, trying to make sure our systems were appropriate, trying to make sure we had good people every day, not knowing what was going to come, but when whatever came, we'd be ready for that.
So our data processor is a company called Jack Henry and Associates. And in the business, there's really three big companies, the big three, that provide data processing to banks. And Jack's one. They have this guy named Lee Weatherington, who his sole job is to kind of do market research and then go out and talk to the customers. So we talked to Lee quite a bit. This quote I got from him: "The unpredictable is only becoming more probable over time." Like, who saw COVID coming, right? Who saw Trump getting elected? It's so hard to know what's coming around the corner. The unpredictable is becoming more frequent as time goes by. And if we get to a point of acceptance of that, it'll really give you a brand new, fresh, and I would suggest you inspiring lens through which to see the world and be better prepared for what's in store for us. So, as Glenn mentioned, when COVID hit, we didn't see it coming. We put 400 people onto our work from home software, sent them home. We had to come up with new sick policies. We had to close all of our lobbies. We made a number of decisions very, very quickly, but we did it. And why did we do it? Because you had to do it. Those that didn't do it were in big trouble. We don't know what's coming, but I'm pretty confident that whatever it is, we'll put our heads together and try to figure things out.
And we're back to those three things. We've got good people that we know well. Our average length of employment with banks over 8 years. We've got good people that understand us, know our culture, brand values. Trying to broaden that perspective, understand we're going to get through this. We've gotten through a lot of things before, and then simplify it. Let's focus on what you can control. Do the best you can, what you can do something about. Don't worry about the things you can't. Be aware of them, acknowledge them, but don't spend all your energy on them. That's what we've got in PowerPoints.
Well, we pretty much have already touched on all this.
That's awesome.
Questions?
Yeah,
Next
questions.
slide. There we go.
There, now we can ask them.
Now you can, that's all.
So with the like big growth that you guys had, getting to your 2021 or 22 goal, will you, when everything kind of gets rolling back on, will you see a decline, or will you just be now at a new point to keep rising?
That's a really good question. I don't think we know exactly, right? So we grew so fast as the deposits all came on. We understand why that happened, a bunch of liquidity in the market. Tom and I talked a little bit about this driving down here. I think we may see a little setback. You know, we may lose some of that. And then I think it'll probably be flat for a little while. So some of that will just kind of, the money that got thrown in the system will work its way out, but we'll continue to attract new customers. We open 1,000 new accounts every month. So, so as that, some of that money goes out, we'll kind of flatten out as the new customers come in and kind of get a kind of a little equilibrium there. We saw a little bit about that after the last downturn when rates really shifted. We had a lot of people who had money parked with us, and there started to be other investment opportunities. Some of that money rolled out, but new customers came in and kind of kept us at an even spot.
I guess my thought is it's all about what happens next. You know, if we do see another surge and there's a big shutdown and people kind of freak out, they'll probably stay. If things kind of start improving and people say, I think the stock market's through its worst, I'm going to take my money out of the bank, put it in the stock market, buy real estate, then we could see it taper up. It's hard to say.
Yeah.
What else? Yes, sir.
So let's say the savings rate in America does change from the past, like it's been typically below 10%. If it's, say, stayed around 10% after this crisis, would you guys be happy or upset about that?
Well, you know, traditionally, the savings rate was kind of how we got our money. People say, when the Fed injects $9 trillion into the system, it's hard to say. You know, everything we're seeing now is really unlike anything we've seen in the past. So it's hard to look at history and say, oh, well, this is the way this works, because I'm not sure that's the way it's gonna work going forward. Generally speaking, savings rate increasing has always been a good thing for the United States. It's more capital to grow.
And one of the things we look at as a bank is we position ourselves with our balance sheet mix, our assets to our liabilities, because we don't want to end up like the savings and loans did in 1983 or whatever. So in a rising rate environment, we tend to expand that net interest margin and be more profitable. And we position ourselves exactly for that. Now, what's happened with the rates being pushed down is that the difference becomes much smaller with that rising rate, because you try to go out a little longer to try to get a little bit of return. But we still are positioned that rates go up, we do that. Yes.
Kind of going off of that, with the start of COVID, when people were digging into their savings accounts, did you see like a big decrease in profits when that happened?
No, what we did see, and this is the liquidity event for the bank, and one of the things that we worried about was when that hit, like, of course, people were buying toilet paper like crazy, right? I don't know what they were using before, but the same thing happens with people's cash. It's like, I got to get to the bank and get my cash out because I don't know what's going to happen. So one of the things we did right away is we said, you're with the Federal Reserve Bank, and make sure we got plenty of cash on hand so that when our customers come in, we can give them money just because they wanted that to be more comfortable. So we saw that. That's what we saw.
And then it went away.
Yeah, just like the toilet paper.
Take the questions.
Yeah, I was just curious. So like, you guys experience like severe liquidity issues, kind of similar to like what happened this last September when the overnight rate spiked to like 11%. How does that affect you guys as a community bank? If there's like a trickle down effect or anything?
Well, no, we didn't experience anything like that. That was really kind of a money center bank phenomenon where they were trading overnight funds. Back to when I talked about the difference between core deposits and wholesale funding. We've been very fortunate that all of our funding traditionally has been core deposits, opposed to what we call hot money that will come and go at the whim. That was a very interesting blip in history, and I was following it kind of closely because I thought, well, is this the first shot of something bigger coming? Well, it turns out I think it was an aberration in the market and got caught. No, it didn't affect us at all.
You know, a little bit along those lines, in March when this happened, we said, we don't know what's going to happen with those deposits. So we went out and got some wholesale funding. We said, we want to make sure we're able to take care of our customers so there is no liquidity event here. And we laddered them so that every month they rolled off so that we're out of it now. But we wanted to make sure we had that option. It's too late to do it when you need it. So you better be prepared for it.
I'm kind of going totally off topic a little bit. When students hear banking, it might scare them away. What like job opportunities are there, either with Alpine Bank or just in the industry, to not have it be such a sound like a niche market of going into just bank?
Well, and maybe a little bit of that is, what the hell does a banker do?
Yeah.
You know, we manage relationships, we take care of customers and communities, and manage people. So it's really not about accounting, banking, it's a people business, and that's really where it's focused. Much more so than I think it even used to be.
So I ran a bank in Telluride for about 12 years. And what I loved about that job is you never knew who was going to walk through the front door. And they come into my office and say, got a minute? I say, sure. And everybody had a story. And everybody told you about how they made the money that they had, and now they wanted to come to Telluride and buy a house or buy a condo or whatever it was. But every day was different. You just never knew. There were some parts of your day that were the same, but you just never knew who was going to walk through the front door. And I met some fascinating, amazing people. Now Telluride is a little bit different than other places, but I think everywhere people come in the bank and they've got a story, and
well, you said
try to help
the desk from a young couple, maybe got married. Really, they're trying to build their new house. They're trying to do something that on paper really is hard to work. And what can you do to help them get there? And how can you do something that really changes their lives? And the reason a lot of those banks I talked about before in eastern Colorado that Grandpa started the bank 100 years ago is because the economy wasn't growing and people couldn't get what they needed. He saw a need for that and started that. So really it's about building relationships, helping people, and helping communities grow and succeed. It's not about, banking doesn't sound very interesting to me
Yeah.
either.
As you,
I'm not a very good banker, but I think I'm pretty good with people.
yes.
So I guess the other answer is, we are always looking for recent college graduates that have an interest in community banking. We have an officer training program, which lasts about a year. You learn every aspect of bank operations, lending, compliance, and then you're sent out to a location and start dealing with customers. Be part of a team.
I saw that training program was in Grand Junction and that it's a year. I was kind of curious, does it state like after the training's all complete, do you stay in Grand Junction, or is that something that's an option?
Well, if you go online and fill out the application, one of the questions is, are you willing to relocate? And everybody always says yes, but
Which is the right answer.
which is the right answer. But when we sit down in an interview, so if you've made it through our testing and application process and you get to an interview, we usually say, well, we have 40 locations. We cover everything from soon to be Fort Collins, Boulder, Denver, to Durango, pretty much the whole state. Instead of saying, where do you want to go? We say, what might be the top 3 places that you really would like to live? And on the same hand, what might be the 3 places you go, I really don't want to go to so and so. So we try, sticking a square peg in a round hole is never a good strategy. So if you want to be in Vail and we need somebody in Vail, we're going to send you.
Right. And that's the other part of it. Not everybody needs somebody all the time. So you try to match where the need is and where the desire to be is. And that's a art, not a science, as you work through it. The other thing is, if you're flexible and you can move more, opportunity tends to present itself more if you're looking at 40 locations instead of 2.
So I had a question about banks, just in general. Did somebody else have a question?
I do have a couple.
Oh, you could go.
Well, on the topic, I guess, do you guys hire any actuaries?
Actuaries?
Well,
Yeah.
not to do actuarial work.
Sure.
I think we might have somebody out there. We have 800 employees, so I think we might have somebody that has an actuarial background, but they're doing
Credit analysis or
Yeah.
something else.
some other kind of analysis.
Second question, this is way different than that. You mentioned all the banks that were bought up by other banks, how it went from almost 10,000 to about 5,000. How much of that was directly caused by the financial crisis?
There was some of it, but there were 15,000 before there were 10. So that's been a trend for a long time. And technology's added to that. Just the way people do their banking has changed a lot of that. The other part of it is banking assets haven't shrunk, but the Wells Fargo's have gotten bigger. Those banks have gotten bigger too. So there was a period where a lot of that acquisition was going on. A lot of those banks disappeared. But there were some of those after the last financial downturn where it was like, a lot of that was fatigue. It's like, you know what? This business is hard. The regulatory pressures changed. The Dodd-Frank Act that came out after that. Now I got a regulator, in my ear all the time telling me what I can and can't do, and I can't take care of the customers who want to build their new house. I'm just tired of it. I'm just selling it. So there was some.
Those 2 deregulation acts in the 80s helped that too.
Right.
Banks were buying across state lines and everything else.
Right. Well, Colorado didn't have branch banking until, they had it phased in.
Right.
There were 10 branches in the state approved for low economic areas, I think in 1991, and we had 2 of them. That was it. There was 10 branches allowed in the whole state, and now you can branch anywhere.
Just to follow up on Glenn's answer, I think if you looked at a graph of acquisitions, you would have seen a spike during the last downturn, but then it came down and it kept going. Right now, the 6 largest banks in the United States, I might be able to name them all: J.P. Morgan, Citi, Bank of America, Wells Fargo, U.S. Bank, and J.P. Morgan. Anyway, they have 60% of the deposits in the country. So 6 banks have 60% of the banking market. So you look at community banks, and we're just kind of a blip on the radar screen.
I think there's a return to people wanting to know who they bank with, though. I think, there's a technology piece, and there's some of that that's hard to line up with, but we got pretty much similar stuff.
Our problem is marketing. If instead of calling us a community bank, if we call ourselves a craft bank, everybody knocked our door down because they think craft distilleries, craft beer, craft bank, right?
So I have a question. What's your strategy behind acquiring new customers? You talked a lot about how your company culture is going out in the communities, doing outreach, fundraising, that sort of thing. Day-to-day basis, what does it look like to acquire new customers?
Well, let me go back to my last comments. Doing those little things right day in and day out, folks know what you can't control. Our customers are our best referral source for us. Some of you may be familiar with what a net promoter score is. So industries of all types do that. So out of 100 people, how many would recommend you to their family and friends? In the financial industry, 35 is the average. USAA, the insurance firm out of Arizona, says they're the highest in the industry. They're like 67. Ours is 82. So our best source for customers is our customers. And that's because we're engaged in the community. We're seeing them in nonprofit events. We're got a scoreboard up at the high school or whatever it is. But that's our best source. That's how we get our customers. We don't buy them.
Right.
Which some banks do.
We really don't do much advertising,
Okay.
promotion of product. You know, we don't say, hey, come in and get a loan at 2%.
We never do product advertising. We do community marketing.
But we also feel like a lot of people choose us just because of the brand.
Right.
They've heard about us, they know about us, maybe somebody tells them to come in, but they have a positive impression of Alpine Bank. That's how people choose us.
When I told a couple of years ago when I ran the branch location as the president of the bank, and they said, why should I bank with you instead of Wells Fargo down the street? So I can get this loan for 0.25% less down the street. I said, well, okay, you're a plumber. Are you the cheapest plumber in town? Well, no. It's like, why are you not the cheapest? Well, I'm better than those other guys. Thank you. Can you call the bank president of Wells Fargo on the phone tomorrow morning if you want to? No. Okay, here's your loan documents. Go ahead and sign. But it's the relations. There's a difference.
Right.
Louise, did you have a
Well,
question?
I was really gonna ask that question of, do you ever, because so much is unknown in the banks, and, when we had Ashley Burt here talking about the Federal Reserve, it was interesting. He had said they had some representatives that would go to the Federal Reserve meetings, do you feel like as a small community bank, you're represented well? Do you ever feel like regulations or something else could shut you down? I mean, when you're the community bank in Colorado facing all these large institutions, I mean, it wasn't too long ago that they shut the doors on Bear Stearns, which I know is a different type of financial institution, but what do y'all think about that? I mean, do banks ever just shut?
It's an important part of your business is managing your regulatory relationships. Because we're a state chartered bank, so the state of Colorado, and we're pretty close to them. They understand Colorado, they understand doing business. I actually am on the board. I chair the board of the state of Colorado Banking Board. So we're familiar with those guys. They're our primary regulator. Because we're a holding company bank, the Federal Reserve Bank also regulates us because we're a holding company. So we know the people in Denver, we maintain relationships with them. They understand who we are. And then the FDIC, because the FDIC insurance also regulates us. And the local people, we know them, we've got really good relationships with them. Now the problem lies when you get further away, and there's some little, consumer compliance is the one that can trip you up. It's like, you didn't give that piece of paper to that person on Thursday, you give it to them on Friday, you should give it to them on Thursday. And as that rolls up the chain to Washington, D.C., they don't know, hey, it was what happened, why that happened. They just all they care about is checking the box. But managing our regulatory relationships is very, very important. We spend a lot of time doing that.
Yeah.
And I would say even at a higher level, having good relationships with your representatives in government, because a lot of this regulation starts in Washington. And so Cory Gardner, Michael Bennett, our two senators, we try to make sure that they'll take your call. And if you see something coming, you can explain, look, this is why it's bad for Alpine Bank and bad for Western Colorado. And hearing from people, I think, is really, really important.
There's a group of Colorado Bankers Association sends a group to Washington, D.C. every year. And I went a few years ago, we went around and sat in Cory Gardner's office. He spent an hour with us saying, what do you guys need? What's going on? What's really going on in your communities? And Michael Bennett's the same way. So, those are two guys from across the aisle, but they both are interested in their communities in their state. And both spend time with us trying to say, what can we really do to make sure we're taking care of you? Because we know you're taking care of our communities.
Scott Tipton just lost the primary. He was our House of Representatives for our district, including Gunnison. And he was a friend of banking. So it was always good to talk to him about what was coming through, why we liked it or why we didn't.
And when the COVID thing started, and we were trying to figure out how do we do these extensions for our customers and not get in trouble with the regulators or the accountants, one of our executive who lives in Denver got with Corey Gardner and sat down and said, here's exactly what we need. We got to get some relief from the accounting industry, we got to get some relief from regulators, that just because we made this concession, this loan is not considered troubled debt restructure, which if you read the definition, it would be. Because the troubled debt restructure says I can't make the payments that are along the original term because of something. Well, this is something, and everybody's got this something.
Right.
Well, you guys have been an amazing audience.
Everybody, thank you. Oh my gosh, we definitely want you back. This was so interesting. I think in this time of COVID, the speaker series, I loved it because so much has changed. I mean, so much changed overnight, and it's so impressive to see what they've put in place, what they've done, and but how they also realize, kind of foreseeing the future too is hard. So thank you so much.
Thank
We really appreciate it, and I feel like everybody got a lot out of it.
And if anybody is going to the dinner, just pop over to me real quick, and that'll
Right.
be at Garlic
Yeah.
Mike's.